Capital market, a detailed overview. Learn what the capital market is, its types, instruments, participants, and importance. A simple and detailed overview of the capital market for beginners and investors. The capital market plays a crucial role in the economic growth of a country. It helps businesses raise long term funds and provides investors opportunities to grow their wealth. This article explains the capital market in a simple and easy to understand way, making it perfect for Blogspot readers. Two, types of capital market. The capital market is broadly divided into two parts. 2.1 Primary market. The primary market is where new securities are issued for the first time. Features: companies raise fresh capital. Investors buy securities directly from the issuer. No trading between investors. Examples: initial public offer, IPO. Follow on, public offer, FPO. Rights issue 2.2. Secondary market. The secondary market is where existing securities are traded among investors. Features: provides liquidity to investors. Prices depend on demand and supply. Includes stock exchanges. Examples: NSE, National Stock Exchange; BSE, Bombay Stock Exchange. 3. Instruments traded in the capital market. Equity shares ownership in a company with voting rights and dividends. Preference shares. Fixed dividends but limited voting rights. Debentures and bonds. Debt instruments that pay fixed interest. Government securities, G-SECs, low-risk bonds issued by the government. Mutual funds and ETFs, indirect investment instruments, linked to capital markets. 4. Participants in the capital market. Investors, individuals, institutions, and foreign investors who provide capital. Issuing companies that raise funds for growth and expansion. Stock exchanges, platforms where securities are traded. NSE, BSE. Intermediaries, brokers, depositories, registrars, underwriters, regulators. SEBI ensures transparency and investor protection. 5. Capital market versus money market. Feature: capital market, money market tenure, long term, short term instruments, shares, bonds, treasury bills, CPs, risk moderate to high low returns, higher lower purpose, capital formation, liquidity management. 6. Importance of capital market: promotes economic growth, encourages savings and investments, helps companies expand operations, generates employment, provides liquidity to investors. A strong capital market reflects a healthy economy. 7. Role of SEBI in capital market. The Securities and Exchange Board of India, SEBI, regulates the Indian capital market. Key responsibilities: protect investors, prevent frauds and unfair practices, regulate stock exchanges and intermediaries, promote transparency. 8. Risks in the capital market. While the capital market offers growth opportunities, it also carries risks. Market volatility, economic fluctuations, company specific risks, global events. Proper research and diversification help reduce these risks. 9. Who should invest in the capital market? Long term investors, wealth creators, professionals, and students learning finance. Anyone willing to take calculated risks. Beginners should start with mutual funds or blue chip stocks. Conclusion: the capital market is the backbone of a country's financial system. It connects investors with businesses and plays a vital role in wealth creation and economic growth. Understanding how the capital market works helps investors make informed decisions and achieve long term financial goals.